Hi everyone. Welcome to Level Up Dividends channel. Almost half of my channel subscribers didn't ring the notification bell to get alerts every time I post a video. By doing so, you'll make sure you don't miss any video and help me get a better YouTube feedback about the videos I post. Anyways, I'm covering 5 undervalued stocks that combine both dividend growth and a potential decent price appreciation. The common point among these 5 is a very, very secure dividend safety score. Let's get into it. Stock 1, Medtronic. Medtronic creates, manufactures, and distributes device-based medical therapies to healthcare systems, physicians, clinicians, and patients worldwide. Dividend yield, 3.19%. Dividend safety, 99. Dividend growth, 13% per year in the last 20 years. Dividend growth streak, 45 years. In their November 2023 presentation, Medtronic confirmed a 5% growth in their cardiovascular sector. This growth is driven by strong performance in pacing, diagnostics, aortic, cardiac surgery, and coronary. The company confirmed also a 4% growth benefiting from strength in core spine and neurosurgery and a 6% growth driven by advanced surgical. Analysts forecast a 5% price appreciation potential. 6 analysts recommend to buy the stock and tend to hold it. The stock reached $137 in September 2021 and has fallen from this top, but since the 90s the stock has been in an uptrend. It's very likely for the stock to get to this $137 mark. Of course, it could take several years to get back to this price, but for the long-term investors, this is very likely to happen. Stock 2, Visa. Dividend yield, 0.77%. Dividend safety, 99. Dividend growth, 18% per year in the last 10 years. Dividend growth streak, 15 years. 17 analysts rate the stock a buy. The price target is $288, which is 6.6% higher than its current price. Stock 3, Elven Health. Elven Health is a health benefits firm. The corporation is divided into 4 business segments: commercial and specialty, government, Carillon RX, and other. It helps consumers, families, and communities throughout the care journey by linking them to the care, support, and resources they need to live healthier lives. Dividend yield, 1.27%. Dividend safety, 99. Dividend growth, 16% per year in the last 10 years. Dividend growth streak, 11 years. The company seems to be doing very well in comparison with its peers. The number of members enrolled in its premium plan has grown by 17% from 2018 to 2023 while declining in the general industry. The revenues from its Carillon services were $1 billion in 2018, $6 billion in 2020 and doubled in 2022. However, the overall operating margin all segments included is a shy 5%. This is not the kind of exciting margins I'm looking for. Still, we can't say it's been a roller coaster. Indeed, it has been steady for the last couple of years. Analysts forecast a 20% upside potential for the stock. Having a P/E ratio of only 13, it could be a good time to get interested in Elven Health. The 4th stock I would like to highlight is Roche Holding. Dividend yield, 3.70%. Dividend safety, 99. Dividend growth, 10% per year in the last 20 years. Dividend growth streak, 31 years. Roche is a Swiss company that offers pharmaceutical products in different therapeutical segments like neuroscience, oncology, infectious diseases, immunology, ophthalmology, dermatology, and more. The company has a 30% operating margin. The operating margin is a measure of profitability that divides operating income by total sales. I like to see companies with such margins. Unlike highly priced stocks, the company is trading at around $30 currently, which makes it affordable for many investors. A good substitute for Roche could be Pfizer. However, the pipelines it offers look to me larger and more interesting. Vabysmo, one of the company's products, is having an outstanding growth in the US and worldwide. This could trigger more revenues for the company for the years ahead and seems to compensate largely other less successful products like Esbriet. Its price over earnings ratio is of only 13, while in the healthcare sector it is of 18. That means the company is not highly valued. A closer look at Roche is worthwhile. My last stock of the list is Stepan Company. Dividend yield, 1.62%. Dividend safety, 99. Dividend growth, 10% per year in the last 5 years. Dividend growth streak, 56 years. For me, seeing a stock that has been increasing its dividends for such a long time is almost enough to catch my attention. I don't want my dividends to be cut, but knowing that not only the company will not cut its payments but will very likely increase them is the most important check in my dividend strategy. The only thing I could argue about is the 1.62% dividend yield. This is not the yield I look for, but I can cope with it. Anyways, Stepan Company manufactures and sells specialty and intermediate chemicals to other manufacturers for use in different end products worldwide. It has 3 segments: surfactants, polymers, and specialty products. Its operating margin has been staggering around 7-8%. Not too bad. However, its free cash flow margin has been negative for the last 2 years. This is due partially to the increase of the interest rates as the company depends on debt. Besides, the capital expenditures tripled in just 3 years. This is not necessarily a bad sign, as the company could be making external purchases to expand its growth. This is it. Remember, I am not a financial advisor. Don't forget to make your own due diligence before investing. Please push the like button if you like the video and subscribe to the channel for similar content. I'll see you next time.